Hi YouTubers, it's Andy Overman and you're watching Mortgage Matters with myself from Location and good friend Michael Webb of Mortgage Republic. Good morning, Michael.
Morning, Andy. How are you?
Yes, good, thanks. Surviving the inclement temperatures that we're experiencing at the moment whilst recording these episodes. And we've got a great question this week from our audience, Michael. What insurances do I need if I'm taking out a mortgage? What insurances do I need if I'm taking out a mortgage? Over to you.
Yeah, this is a fantastic question, and also something that the FCA this month is going to bring some further legislation and bits and pieces and focus on for mortgage brokers. So there's a few things that you should consider. And there's a few things, well, one thing that is going to be compulsory placed on you by the lender. So if we start with the compulsory insurance, that will give you an idea of what the banks think about the people they're lending money to. They really don't care too much as long as their asset is insured. So your mortgage offer will stipulate that you must have the buildings adequately insured. That will be for a minimum of what the surveyor has said is the minimum rebuild amount. Be very careful with that, particularly if you've owned your property over some time and you haven't reviewed that rebuild amount. I have had a recent situation where people have come back having a total loss through policies they've set up themselves before we were working with them, and they were underinsured quite considerably. So your compulsory insurance is the buildings. That means that the bank's asset is insured should there be a loss. There'll be some things that are written into the mortgage offer that state things like the bank building society will need to be named on the policy as having an interest in the property. There'll also be things like that are very common within mortgage terms and conditions, that if there's a buildings claim over £10,000, the bank want the right to manage the claim to ensure that the buildings are adequately repaired and things like that. Hence, they want to be named on the policy.
Just jumping into that answer, Michael, if I may, what happens in a scenario where you've failed with your obligation to the lender to adequately insure the property? What are the potential pitfalls or outcomes for the borrower?
Yeah, so the only adverse outcome is if you need to make a claim. So obviously you're obligated by contract to insure the property. I would not be surprised if you did an audit across every mortgage property in the UK, you would find some that aren't insured. That's just statistics. But those people will only come unstuck if they need to make a claim on the property, or there's a situation where they would need to claim and there's no insurance to back it up and they don't have the funds themselves to rectify it. One of the most common issues and people misunderstand with buildings insurance is making sure, and this applies to contents insurance as well, of course, but making sure that you are adequately insured is very, very important. Now, the reason for that is they will pay out proportionately. So let's say you have, I'll keep maths easy because it's quite early that we're filming these. Let's say you have a total loss on your buildings, and the quantity surveyor and loss adjuster come around and say, right, to rebuild this is going to cost £200,000.
Yeah.
But you're only insured for £100,000. Okay. You will not get a £100,000 payout. You will get a £50,000 payout because you were 50% underinsured. So they will only insure you for 50% of the loss.
Right.
So therefore, instead of being £100,000 in a hole, you're £150,000 in a hole. And you then end up with a situation where basically you probably wouldn't be able to pay the mortgage back. And you're going to find yourself in some legal problems through breach of contract and losses and all of that. I mean, that would probably end up, I would assume, in a bankruptcy situation eventually, because you owe you owe your mortgage debt.
It's really
And you
difficult,
haven't
isn't it?
insured
Because
the asset.
I would imagine that there were a lot of people in their homes, particularly kind of our generation, who may have been in the same home now for 10 or 12 years, that adequately insured the property when they first mortgaged it, but are probably, particularly with costs escalating, if you look at the building trade at the moment,
Yes.
many builders are saying that just the cost of supply materials and build is up 30% over 2 years. Well, that means if you were adequately insured at, using your maths again, at 200,000 2 years ago, effectively it needs to be a rebuild of probably 30% more 2 years
Yes.
later. So I
Yeah,
wonder
so
how
a
you...
lot of insurance products are kind of try to negate this risk. And a good insurance policy would have a very, very high rebuild value as standard. So a lot of the policies we do will either have an unlimited rebuild. So they don't actually state a number. They just say your buildings is insured for rebuild, whatever the cost may be. Or we'll have a substantial number on it, like £1.5 million, which for most properties that we are dealing with would be more than adequate to rebuild them, and in essence is an unlimited rebuild situation. The policies that put, say, 1.5 million on it rather than just an unlimited are doing so that when you get to the much larger properties, they're saying this policy isn't really right for you. You need something a bit more bespoke, because this is going to cost you a couple of £1 million to rebuild if you had a total loss. And therefore we need to insure that risk adequately. So that's the building side of it. So the bank's all sorted. They're happy. Obviously, you'd look at your contents.
And that's the compulsory. Sorry, that's the compulsory.
Buildings is compulsory. Contents isn't, but most people would do if it's a freehold property, would do buildings and contents together. The same underinsured situation happens with contents and is much more frequently an issue because contents policies are claimed on a lot more than buildings policies. So therefore, if you had a total loss and you were only insured for 20 grand, they said you had 40, you're only going to get 10 out and you've got a big problem. So making sure you're adequately insured is important. And I think people would realize, if they really sat down to replace everything they've got, they'd be shocked at how much it would add up to. I mean, most houses, there's £2,000-3,000 just in carpets. So, and if you had to replace every item of clothing that you own, obviously you haven't gone and bought those in one go. You bought them over the last few years, so it's a lot of money as well. The other things that are really important to look at will depend on your individual situation and requires you to really have a conversation with a skilled mortgage and insurance broker who's going to engage this conversation with you. But the things that you should be looking to consider and then prioritize based on your budget and your situation are life insurance. And the reason I say prioritize is if you're a single individual buying a house with no dependents and no one else on it, life insurance should be your lowest priority. But if you are a family of a couple of people with a couple of children, then probably life insurance is going to be much higher up the priority list. You've then got things like critical illness, which can run alongside the life insurance as a joint policy if needed, and then income protection to protect your income to pay your mortgage or your committed bills, or actually your whole salary on an indexed basis until you retire. There's lots of options there. So they're the key things you should be looking at, but you need to engage a conversation around your budget, around what you're comfortable paying, what you see as priorities. And like I've said, if you're a single individual, you are the most important thing. So therefore, protecting your income should be more important than protecting your life. Now, if budget's available, then having a life insurance policy, it's not saying you shouldn't have that to make life easier for the people you'll leave behind. And so you can inherit your property on, because an encumbered by mortgage property cannot pass probate. Therefore, you couldn't leave it to your brother. It would have to be sold. And therefore, you may want to do that. But a much higher priority for that individual should be, well, I need to protect my income because I am the only source of income coming in. Whereas someone with children and a partner may well have different priorities. So it's really important to engage that conversation and think things through, talk things through, and get relevant recommendations from a mortgage insurance broker who you're working with.
Okay, so let's just unpick those and explain what they are for the benefit of our audience. The first you mentioned is life insurance.
Yep. So life insurance will basically pay out if an individual is to die. They can be set up in a few ways. So as a joint policy, if there's two people on the mortgage, and that would be called joint life first death. Therefore, it will pay out on the first instance of someone dying. Usually these policies are, if they're related to a mortgage, will be a decreasing term assurance. In effect, the amount that it pays out will reduce month on month as your mortgage reduces, usually not as quickly as your mortgage, so that there's a little bit of surplus and you're never left with a deficit should you need to claim. These policies typically have no, once they're medically underwritten and in force, after the first 12 months, typically they have no clauses on them. I say the first 12 months because usually they have a suicide clause in the first 12 months. But after that, usually it is one person has died, no matter what the reason, they will pay out. The next policy would be a critical illness policy. Yeah. Okay, so this is something that you really do need to take some advice on, because critical illness policies are very different. They, unlike a life insurance policy, which will typically be you've died, it pays. Critical illness policies will create terms and conditions and descriptions of certain critical illnesses, and they will cover a range of critical illnesses, and each policy will cover different ones, although there'll be a broad category that is the same to be classed as a critical illness policy. But the severity and medical definition of what you've got will vary policy to policy. So, for example, a critical illness may be losing your sight in both eyes. Now, the policies will have an element of kind of level of what they're saying sight loss is. Some may be total sight loss, you've got total blindness. Others would be you can't read a letter of X size from X distance. Right. And therefore we would class you as technically impaired and therefore having a critical illness. And that distance and that letter size will change policy to policy. Right. So that's a very easy example. But they would cover your broad kind of things like cancer, heart attacks, strokes, all the main things, but again at certain severities as outlined in the policy. And obviously the cost of that policy will be more, because statistically speaking, by the time you reach 70, 1 in 2 UK adults will have a critical illness.
So I'm guessing then it's really important that you take specialist advice around this, because for me, if I were going online and just searching for a critical illness, I wouldn't be looking probably at the finer details of those descriptions of what qualifies as.
Yes.
You'd see the market price that was being offered and think that's the cheapest, I'll go for that. But what you're actually saying,
they're not the same. So what you have to understand, I guess, is you're not manufacturing something. So you can't go and buy a widget cheaper to make your product cheaper. The only way you can make it cheaper is to reduce the risk that you will pay out. Therefore, what you will broadly find is that people who are pricing their products really, really cheap on these online sourcings will have contracted your ability to claim on them to enable them to be that cheap. Now, that's a very broad statement, but because the reality of any marketplace is you could have someone with excellent terms and conditions for the individual being insured with a very strong price, and that's what you want to find. But usually you need to find the balance between the cost and the terms and conditions, and an understanding of what you're giving up against what you're gaining and things like that. And that's where an expert broker would be able to help you. They'll also have different software that's only available to the market the broker market that can help explain the differences and compare the policies a lot easier than you sitting down with 50-page documents and trying to line them all up and work out what you're getting for one and what you're getting for the other and the cost benefits. So that's how critical illness. A lot of people may have a life or earlier critical illness decreasing term policy. It's very, very common for them to take that out on their mortgage, meaning if one of them's to die or get a specified critical illness, they would get a payout with the intention of paying your mortgage off. The thing to remember with all of these policies is they pay out to your estate or to the beneficiary of the trust that you have set up. They're not taxable. Insurance payouts aren't taxable. However, if they pay out to an estate, there may be tax through probate if you haven't set it up via a trust. And again, that's something you need to take some specialist advice on whether that's relevant to do. So you get your money quicker, and also you don't need to have it pass probate and form part of an estate, so potentially have inheritance tax on it. So there's those kind of things to bear in mind.
And
then finally is the income protection. Mm-hmm. So the idea of income protection is to give people sick pay is probably the best way to describe it. Right. So what an income protection policy should do is tie in with your employer's sick pay. Now, a lot of difference in the marketplace with regards to that, but very generally outside of what I would call a government organisation, police, army unlimited sick pay, but NHS, fire brigade, government, local authority, all of that, who potentially have quite good sick pay. I mean, the NHS and police will escalate over service up to 6 months full, 6 months half. I don't know any private employer off the top of my head that's giving that. I'm not saying they're not out there. They're just not common. So very commonly, most people get nothing for the first 3 days. Then they get 2 weeks sick pay. And then they're on statutory sick pay, which is like less than 100 quid a week. The number's about £80 something a week that you get. I can't remember the exact number off the top of my head. I think it might have changed recently. So but irrelevant, it's not a lot of money is the key. And won't pay people's bills, not by a long shot. So the idea is to then replace your income with an insurance policy. So if you are off sick for, say, 6 months, after 4 weeks, your income protection policy starts paying you an amount of money. Usually, depending on your salary, you can insure a maximum amount because you will also get statutory sick pay. You will receive that as well. So therefore, you can't be off sick and getting more net income than you would be at work. Yeah, you can't put yourself in a better position. You can only return yourself to normality. So the reality is that what you're insuring will be a little bit below your net income, typically, and then you'll get your statutory sick pay, and that will bring you back broadly to what you would be getting. However, that would be the maximum you could insure. A lot of people, based on budget and costs, would insure less. And that may end up being, say, their mortgage payment plus their committed bills rather than their whole net income. And again, you can take it for different terms. A lot of people will look to take it all the way up to their anticipated retirement age. Other people would take it for just the mortgage term, or you can limit it to payouts of a year or 2 years, any 2 years or multiples of 2 years. There's lots and lots of options, way too much for us to bore people with on YouTube now, but the reality is you can protect your income. And with the current statistics stating, the government came out with these very recently saying that should a family or an individual lose their income, on average in the UK, that family unit can pay their bills for 32 days and then they're out of money. So that is an average. Now, don't get me wrong, there'll be people sitting there thinking, well, I can do it for 2, 3, 4, 5 years. Fantastic. And there'll also be people thinking, well, I can't pay the bills this Friday. So, but as an average, just over a month, people can survive without any income coming in. So it is very, very important that people look at this, because it's not just illness, it's injury. You know, if you have a car crash, completely, you're driving to work, it's completely not your fault. You're not ill. You're a fit, healthy individual, never been to the doctor in the last 10 years, and some idiot crashes into you and you break your leg and now you can't work for 6 months. Completely out of your control. Whilst, yes, you try to claim some bits through your car insurance and things like that, you're not going to get your income back.
No,
you know, so, and you're definitely going to have a waiting period that you're going to get yourself into a lot of trouble whilst that's happening. So these are really important things that people need to engage in. Sometimes people shy away from it. This is a really poignant thing to bring up, that people don't want to talk about it. They don't want to talk about dying, getting sick, things going wrong. It's really important you confront that, and you confront the reality of how you would deal with things if you did nothing.
It's also really worthwhile noting, Michael, that at the moment, a lot of our audience, in fact, a lot of the UK, are making some really bold decisions about where they allocate their monthly spend. Let's face it, the grocery shop, you know, we talk about this week in, week out, we talk about inflation, we talk about interest rates, we talk about, you know, going out and you know, how the family purse is being squeezed. And it, you know, it's very real. You just look at energy prices, for example. However, there are going to be people, and you know, forgive me, that there are going to be people out there that are effectively looking at the fact they've had an insurance policy for 10 to 15 years. They've never had to make a claim. They're going to look at that cost, 100, 150 pounds a month across the insurance policies, and think it's 150 pounds a month times 12 months times 15 years. We've never needed it. Can we sacrifice it? I would urge those people to speak to yourself or one of your team. You know, insurance policies are a waste of money until you need them. And when you need
what I would say is every insurance policy I've ever set up, I hope, is a waste of money.
Yes.
Because if it's not, something has gone massively wrong for you. So you want to hope that your life insurance has been a waste of money.
Yes.
That is all I would say. You want to hope your critical illness is a waste of money, because the minute you need it and you haven't got it, you're going to wish you had it.
I read online a very tragic story recently about a very well-to-do business person who had always earned strong money in the city, and didn't have the appropriate cover, and at the age of 40 something suffered a heart attack and then subsequently multiple strokes and was uninsured. And the devastation that rocked through his wife and 3 children as their life literally crumbled. Everything that they had been used to, the quality of life that they'd been used to, where they lived, you know, just everything changed in a matter of 3 months for that family. So as you say, insurance should be the biggest waste of money that you ever invest in, but boy, if you need it, it's a lifeline. So if there are people out there that are looking to make those choices, and the cost of living struggle is very real for every family at the moment, yourself, Michael, and myself included, you know, we're all as families making decisions about what's important, what can be cut. If you're sat there thinking, am I paying too much for my insurance? Please don't just cancel the direct debit. Speak to Michael, speak to one of his team, speak to a consummate professional that can say, look, actually, based on, you know, it may be that where you're based, you know, where you based an insurance policies or your priorities 10 years ago, your lifestyle has shifted. There may be savings to make, you know, similarly. It needs to be discussed though. So Michael, thanks ever so much. You've answered the question perfectly. What insurances do I need if I'm taking a mortgage? The straight answer is buildings insurance is compulsory, and everything else is dependent on your circumstances. So once again, really appreciate your time, Michael, and look forward to speaking to you again next week.
Yep, speak to you soon.